Everyone tells you that you need to organize your finances for retirement, but no one actually teaches you how to do it. Today we're going to dive into the 7 accounts that you will likely use during retirement. But not only are we going to list these accounts, but we're going to discuss how these accounts can work together so you can have a tax-efficient retirement strategy without having to worry about running out of money or paying more than your fair share of taxes to Uncle Sam. You want to make sure you understand how these accounts work together so you can create your dream retirement. We've got a lot to cover today, so let's get right into it. Account number 1, a checking account. You are probably familiar with this account, as this is where most of your transactions occur. Well, this and the next one we're going to discuss. During retirement, you'll want to make sure that you maintain a minimum balance in your checking account to avoid overdraft and account fees. You'll also want to keep a couple of months of expenses in this account to act as a buffer. Account number 2, credit card. While most people don't consider a credit card an account, they should. In fact, I would be willing to bet that for most people, the vast majority of their personal transactions occur in this account, as credit cards are frequently used for recurring payments. When it comes to your credit card account, make sure you have an account that has 0 fees when the balance is paid off timely. If you want to explore rewards or points cards, make sure you have a plan for how they will fit into your overall financial goals. For example, if you enjoy traveling, use a card that rewards travel activity the most. Or if you do most of your shopping at your favorite warehouse club, use that credit card. Be intentional with how you use the card and avoid the notorious credit card fees. Account number 3, high yield savings account. Let's face it, interest rates on traditional savings accounts are horrible. While traditional savings accounts may offer something like 1 to 10 basis points today, that's like 1 to 10% of 1%. High yield savings accounts are paying an interest rate closer to 4%. That is a massive difference. Online banks seem to offer the best rates on these type of accounts, but using an online bank can create a bit of a delay when transferring your cash to your checking account at a traditional bank. So make sure you're mindful of this delay when you need to get money from these accounts. Also, make sure your high yield savings account is FDIC insured. Account number 4, employer-sponsored retirement plan. These are the plans offered by your employer, typically 401ks and 403bs. During your working years, these accounts are helpful because you contribute to these accounts, and generally speaking, these contributions can reduce your taxable income. Because of this feature, these accounts can have substantial balances in them. While these accounts were effective in helping you reduce your income taxes during your working years, the opposite is true when you begin to draw the funds from these pre-tax accounts. In fact, these accounts can trigger large tax liabilities later in retirement once RMDs kick in. More on that in a few minutes. Account number 5, IRAs or individual retirement accounts. IRAs can be traditional, meaning you pay taxes when you take the money out, or Roth, meaning distributions from the account are tax-free. Regardless of the type of IRA, all of the activity that occurs within the account does so tax-free. So any dividends, interest, or capital gains are not taxed in the year earned. This is an important aspect of these accounts. We'll expand upon that a bit later. These are accounts that you have established for yourself, as opposed to the employer-sponsored accounts we just discussed. By transferring your employer retirement plans to these type of accounts, you're able to have greater control over your investments. Account number 6, brokerage account. Brokerage accounts are your standard investment accounts. You can pull money from this type of account at any time. Interest, dividends, and capital gains recognized in this account are taxable in the year the transaction occurs. Also, the capital gain treatment of sale of assets in these accounts can lead to lower tax rate if the investment is held for longer than 1 year. Account number 7, HSA or health savings account. These accounts are triple tax-free. You receive a tax deduction when you contribute to them. The growth inside the account is tax-free. And when used for qualified medical expenses, the withdrawals are tax-free. So if you're planning for your retirement, you may want to consider funding this type of account. Just remember that they need to be paired with a high deductible health plan. But a word of caution, the tax treatment of these HSA accounts can be less than tax efficient when you pass on. Stay tuned and we'll discuss this in a bit more detail. Don't be one of the people who don't understand how this works. Now that we've identified these 7 accounts, what are the best ways to use them? These are the actions that most people don't take, but should, if they want to have a successful retirement. Checking and credit card accounts. Use these accounts to track expenses and monitor spending. Make sure you have auto payment on the credit card and sufficient cash in the checking account to pay it off every month to avoid the awful fees. Always maintain a couple of months' expenses in the checking account. The last thing you want to do is incur overdraft or late payment fees. That's just setting money on fire. Also, with respect to credit cards, review the charges periodically. All too often, we'll sign up for a free trial that's simply too good to pass up on. But then we'll forget to cancel it, having a recurring charge that we completely forgot about. Review your credit card charges periodically to ensure none of these exist. And if they do, cancel them immediately. High-yield savings accounts. Use the high-yield savings account as a cash reservoir for replenishing your checking account. But rather than holding such large balances in your checking account that don't earn any interest, the high-yield savings account will help you earn interest while you wait. Figure out the number of months' expenses you want to keep in cash to cover any emergencies or rainy days. If it's more than a couple of months, invest the rest in a high-yield savings account. But a word of caution, make sure you keep your eye on the interest rate the account is earning. These aren't like CDs where the rate will stay the same for a certain period of time. The rates on these accounts can change at any time. So if the rates on yours drops, you may want to start looking for alternatives. Also, make sure you know the number of days it will take for the cash to transfer from the online high-yield savings account to your brick-and-mortar's bank's checking account. The last thing you want to do is create an overdraft situation in your checking account because the funds from the high-yield savings account did not arrive quickly enough. Employer-sponsored retirement plans. Your 401k or 403b plan was incredibly helpful to defer income taxes while you were working. But if you're getting close to retirement and no longer work for your old employer, you may want to consider transferring these assets to an individual retirement account. Doing so can help you consolidate some or all of your old 401k accounts into one account. This is important if you have multiple 401k accounts from several past employers and are finding it difficult to keep track of everything, particularly RMDs. Also, your employer's plan may have limited investment offerings, or the fees may be too high. In that case, consider moving these accounts to an IRA. I did another video on what to do with your employer's retirement account when you retire. I'll include a link to that video in the notes below. It's a great resource to help you decide what is the best option for you. I hope you'll watch it next. Planning around IRAs is both an investment and tax management strategy. You want to make sure you have these accounts invested in a portfolio that will help you make sure you don't run out of money. As I mentioned earlier, one key point about these accounts is that the activity within the account happens tax-free, meaning any dividends, interest, or capital gains incurring in these accounts won't be taxed at the time it occurs. However, you will be taxed as you take distributions from these accounts. So you'll want to make sure you manage these distributions in a tax-efficient manner, especially when you are considering RMDs. Making sure you have both traditional and Roth balances will provide maximum tax benefit. And consolidating multiple employer retirement accounts into a single IRA can greatly simplify RMDs once you become subject to them. The brokerage account. The brokerage account is your standard investment account. Any activity in this account is taxed at the time it occurs. However, you can draw money from these accounts completely tax-free. So you will want to consider tax-efficient drawdowns along with your IRA accounts when deciding where to draw money from to cover your living expenses. A couple of strategies to use can be tax loss harvesting, where you can manage any capital gains you trigger by offsetting with losses. Also, you'll want to consider tax location of assets by holding assets that may create a lot of income in the retirement accounts and those that don't in the brokerage accounts. Finally, the HSA. The HSA can be a great account for tax purposes during your lifetime, but it may not be when you die. If your spouse is the designated beneficiary, then the HSA status is preserved. However, if it goes to someone else, it may become taxable in the year that it's transferred. So if you have an HSA in retirement, you may want to prioritize spending down the funds in these accounts on qualified medical expenses before you pass so they don't get taxed upon your death. Understanding the accounts that you have and how they work together is an essential piece of any retirement plan. Structure your accounts so that things are easy to track and tax efficient, so you can keep more of what you have earned. There is another type of account I've been seeing a lot more of lately. This account is the inherited IRA. If you are going to inherit an IRA, or if you're planning on passing on your large IRA to your children, then you want to make sure you watch this video. It's great to inherit money, but inherited IRAs can be incredibly tricky if you're not careful. You can find a link to that video here. If you made it this far, thanks for watching. If you enjoyed this video, please hit like and subscribe. Thanks again for watching, and I'll see you next time.